The world is standing at a crossroads that few are paying attention to. Quietly, two powerful nations are making moves that could shake the very foundation of global finance. The dollar, once untouchable, is now facing a challenge unlike anything in modern history. In the past few months, a silent storm has been building, one led by Russia and China. Russia has taken a bold step, striking directly at the heart of the US dollar's global dominance. At the same time, China has started turning away from US farm imports, changing the balance of global trade that has held for decades. These are not isolated moves. They are signals of something much bigger, something that could redefine the financial power map of the world. Russia's decision to halt dollar trading inside its main exchange is more than a sanction response. It is a declaration of independence from the dollar system that has ruled global markets since World War II. For years, Russia has been reducing its dollar reserves, trading oil, gas, and local currencies. And now it has gone a step further, cutting the demand for US dollars right from its financial core. The consequences of that decision stretch far beyond Moscow. When one of the world's biggest energy exporters stops using the dollar, it sends ripples across banks, trade networks, and entire economies. Meanwhile, China is reshaping another pillar of American power: agriculture. For decades, U.S. farms fed China's industries and people. That trade built billions in revenue and gave Washington quiet leverage over Beijing. But now, China is rewriting that story. It is sourcing massive grain and soybean deals from Brazil, Russia, and even smaller regional players, reducing dependence on the United States. Chinese state planners are openly saying they no longer need American farm goods to secure their future. This is not just trade diversification, it is strategic decoupling. These moves together are more than just economic adjustments. They are a coordinated signal that two global giants are moving away from the dollar system and reshaping their trade routes to build resilience against U.S. influence. If this trend continues, the results could be dramatic: a weaker dollar, more fragmented global markets, and growing pressure on U.S. farmers and industries. In this video, you will learn how Russia's financial maneuver has quietly canceled billions in potential dollar transactions, why China's import reversal could trigger a wave of trade realignments, and what these two shifts mean for the future of U.S. economic power. We will uncover the lesser-known connections between currency strategy and food security, and how they form the hidden front lines of modern economic warfare. Stay with us until the end, because the full picture reveals just how vulnerable the global system built around the dollar has become. By the time this video ends, you will understand why these recent actions by Russia and China are not temporary reactions, but signs of a permanent change taking shape. Welcome to our channel, where we uncover the truth behind global shifts the mainstream rarely talks about. If you want to stay ahead of the headlines and truly understand how power is moving across the world, make sure to subscribe and turn on notifications. The story is unfolding, and it is one you cannot afford to miss. To understand why today's financial system trembles whenever the US dollar is threatened, we need to look back at how it gained its global dominance. The dollar did not become the world's leading currency overnight. It was built through decades of economic power, political influence, and trust. After World War II, when most of the world was rebuilding from destruction, the United States stood out as the strongest economy with the largest gold reserves. In 1944, world leaders gathered in Bretton Woods, New Hampshire, and made a historic decision. They pegged their currencies to the US dollar, and the dollar itself was linked to gold. From that moment, the dollar became the backbone of the global financial system. As international trade expanded in the following decades, countries needed a stable and reliable currency for transactions. The dollar filled that role perfectly. It was backed by a powerful economy, deep financial markets, and global confidence in America's institutions. Oil-producing nations began pricing oil exclusively in dollars, creating the petrodollar system. This locked in the dollar's role not just in trade, but in global energy markets. Whether nations were buying crude oil, shipping goods, or investing across borders, they turned to the US dollar as the universal medium of exchange. Even after the US ended the gold standard in 1971, the dollar's dominance only grew. It became the safe haven in times of crisis, the preferred reserve for central banks, and the benchmark for global debt. Today, nearly 60% of all global foreign exchange reserves are held in US dollars, and almost 90% of global trade transactions involve the dollar in some form. That level of control means the US effectively sits at the center of the world's financial traffic. Banks, corporations, and even governments depend on access to the dollar-based system for everything from imports and exports to borrowing and debt repayments. But this dependence also creates vulnerability, especially for the rest of the world. Since the dollar dominates global trade and finance, U.S. policy decisions have direct consequences across continents. When the Federal Reserve raises interest rates, borrowing costs rise not only in the United States, but in Asia, Africa, and Latin America as well. Countries with dollar-denominated debt suddenly find themselves paying more, even if their economies are struggling. The strength or weakness of the dollar can shift inflation levels, commodity prices, and investment flows globally. Beyond economics, the dollar gives Washington enormous geopolitical leverage. Because most global financial transactions pass through U.S.-linked systems like SWIFT and American banks, the U.S. can impose sanctions that effectively cut off entire nations from the global economy. Iran, Venezuela, and Russia have all experienced the crushing effects of such measures. This ability to weaponize the dollar has made other countries uneasy, pushing them to explore alternatives to protect their sovereignty and financial independence. There is also a structural weakness hidden beneath the surface. The dollar's dominance relies on constant global demand. For decades, that demand was guaranteed by international trade and the trust that the U.S. economy would remain stable. But in recent years, debt levels, political divisions, and frequent use of sanctions have started to erode that trust. When the U.S. prints trillions of dollars to finance deficits or stimulus programs, the rest of the world absorbs the inflationary shock. And when nations start settling trade in other currencies, like the Chinese yuan or Indian rupee, it chips away at the dollar's central position bit by bit. In essence, the dollar has become both a symbol of stability and a potential source of risk. It is deeply embedded in the world's financial structure, yet its dominance makes the global economy dependent on decisions made in Washington. Countries that once saw the dollar as a shield are now questioning whether it has become a double-edged sword, one that offers access and convenience, but also exposes them to pressures they cannot control. For more than a decade, Russia has been quietly working to loosen the grip of the U.S. dollar on its economy. This was not a sudden decision born out of sanctions or conflict. It was part of a broader long-term strategy designed to protect the country from financial vulnerability. After the global financial crisis and the first wave of Western sanctions in 2014, Moscow's policymakers began to recognize that being deeply tied to the dollar system left the Russian economy exposed. the U.S. could at any time freeze assets, restrict dollar transactions, or isolate Russian banks from global payment systems. To guard against that risk, Russia began a systematic process to reduce its reliance on the American currency. One of the first major steps came from the Central Bank of Russia. Over several years, it restructured the country's foreign exchange reserves. The portion held in US dollars dropped sharply, while holdings in euros, yuan, and gold increased. Gold, in particular, became a key defensive asset. By accumulating one of the world's largest gold reserves, Russia built a safety net that could not be easily targeted by foreign sanctions. At the same time, Moscow began using national currencies for trade with key partners such as China, India, and Turkey. Energy exports, once almost entirely priced in dollars, were increasingly settled in rubles, yuan, or other local currencies. This de-dollarization strategy also extended to Russia's sovereign wealth funds and state-owned enterprises. Large corporations such as Gazprom and Rosneft began conducting international contracts in non-dollar currencies. The government encouraged banks to diversify their foreign currency holdings and even offered incentives for trade settlements that avoided the dollar altogether, gradually creating an alternative ecosystem of payments. Russia reduced the need for dollar-based transactions and weakened the impact of future U.S. restrictions. A more visible sign of this policy surfaced recently when the Moscow Exchange officially halted trading in both the U.S. dollar and the euro. This move came in response to a new wave of Western sanctions, which made it increasingly difficult for Russian financial institutions to clear transactions in those currencies. The cancellation was more than a symbolic act. It was a functional shift in the country's financial architecture. Without dollar trading, domestic banks and companies had to rely on rubles, yuan, or other regional currencies for settlement. In effect, the demand for U.S. dollars within Russia's financial system was deliberately reduced, a clear sign that Moscow is accelerating its transition toward financial independence. The implications of Russia's strategic moves are immense. By reducing its reliance on the dollar, Russia is effectively creating a financial firewall against the kind of sanctions that have repeatedly targeted it over the past decade. Every measure it takes to diversify reserves, settle trades in non-dollar currencies, and accumulate gold acts as a shield against external financial pressures. But these actions are not happening in isolation. They are part of a broader, long-term geopolitical strategy designed to reposition Russia as a sovereign economic power that is less susceptible to the whims of Washington or global market volatility. At the heart of this strategy lies the partnership with China. Beijing, for its part, has also been steadily reducing its exposure to the dollar. China is the world's largest holder of U.S. Treasury bonds, yet it has been cautious in recent years, increasingly shifting some of its holdings into gold and other currencies. Beyond reserves, China's international trade policies are signaling a deliberate pivot. By sourcing grains, soybeans, and other essential commodities from Brazil, Russia, and regional players, China is mitigating its dependency on the United States and quietly building a trade ecosystem that bypasses the dollar. This strategic decoupling carries massive consequences. For the U.S., it means a reduction in leverage. Agricultural exports, a cornerstone of American economic influence, are now being redirected. Farmers in the Midwest, who have long relied on stable demand from China, face uncertainty. The disruption in traditional supply chains could lead to falling revenues, lower commodity prices, and growing pressure on the American agricultural sector. Simultaneously, industries that rely on international trade denominated in dollars may face declining influence as global partners increasingly adopt alternative currencies. The financial world is also taking note. Banks, multinational corporations, and investment firms are observing the subtle shift in trade settlements. The increased use of rubles, yuan, and other regional currencies in international contracts signals that the traditional dollar-centric model is beginning to fragment. Over time, this could lead to higher transaction costs for those still tied exclusively to the US dollar, further incentivizing the creation of parallel financial systems that are less dependent on Washington's policies. Russia's approach is methodical. Beyond trade and reserves, it is building domestic mechanisms that minimize exposure to external shocks. Russian banks are increasingly equipped to handle cross-border transactions without relying on the dollar. Corporations conducting international business are encouraged to adopt bilateral agreements denominated in local currencies. Even state-owned enterprises are becoming part of this ecosystem, gradually decoupling large segments of the economy from global dollar flows. Meanwhile, China is complementing Russia's efforts with its own initiatives. The launch of the digital yuan, a government-backed digital currency, is a clear step toward creating an alternative to the dollar in global trade. By facilitating transactions directly in yuan, China aims to incentivize partner countries to bypass the US dollar altogether. In addition, China is strengthening financial institutions and international partnerships that support yuan-denominated trade, particularly in Asia, Africa, and Latin America. The combined effect of these maneuvers is profound. The long-standing assumption that the US dollar is the uncontested global reserve currency is now being challenged in a tangible way. Countries that once relied on the dollar for stability are beginning to experiment with alternative currencies. This is not a speculative trend. It is a carefully orchestrated strategy by two of the world's largest economies to insulate themselves from potential geopolitical and financial coercion. The ripple effects extend beyond economics. Political power and influence are closely tied to financial leverage. By reducing dependence on the dollar, Russia and China are simultaneously reshaping the geopolitical landscape. U.S. policymakers, long accustomed to the implicit influence granted by dollar dominance, now face a world in which their ability to dictate terms through financial measures is gradually diminishing. This shift could have far-reaching implications for everything from sanctions policy to global trade negotiations. Understanding the broader implications requires a closer look at global energy markets. Russia, as one of the world's largest oil and gas exporters, has long relied on the dollar for energy transactions. Yet the recent trend shows a deliberate shift toward settlement in rubles and other non-dollar currencies. This is not only a defensive measure, it is a statement of financial sovereignty. By reducing dollar transactions in energy markets, Russia is directly challenging the US-dominated petrodollar system, which has been a cornerstone of global finance for decades. The consequences for energy markets are multifaceted. Firstly, countries that trade extensively with Russia may gradually adopt ruble-based contracts, especially if they seek to avoid exposure to US sanctions. This could create a parallel network of energy trade that operates independently from traditional dollar systems. Secondly, as these alternative arrangements gain traction, the dollar may lose its exclusivity in energy transactions, reducing demand and potentially weakening its global position over time. China's role in this energy shift is equally significant. As the world's largest energy importer, Beijing has leverage over multiple markets. By negotiating deals directly in yuan or bilateral agreements with countries like Russia and Saudi Arabia, China is facilitating a gradual transition away from dollar dominance in energy. This is not a sudden change, it is a calculated strategy to ensure long-term economic resilience. Beyond energy and agriculture, other sectors are also feeling the impact. Technology trade, infrastructure investments, and international financing are increasingly exploring alternatives to dollar-based systems. For example, Russia and China are actively promoting regional payment systems, which reduce the necessity of US-based financial networks. These initiatives allow countries to transact independently, avoiding the potential vulnerabilities associated with reliance on the dollar. The cumulative effect of these policies is clear. A multipolar financial world is emerging. While the US dollar remains dominant for now, cracks are appearing in the system that has been largely uncontested for decades. This emerging landscape poses challenges for US economic policy, forcing Washington to reconsider strategies that assume near absolute dollar control. Global markets, too, will need to adapt to a world in which multiple currencies and alternative systems play a more prominent role in trade and finance. Russia's and China's strategic moves also have social and political dimensions. Reducing dollar dependency strengthens domestic economic stability, insulating populations from sudden shocks caused by US monetary policy. For countries under sanctions, this model offers a blueprint for economic self-reliance. Moreover, it reshapes international power dynamics. Financial influence is no longer concentrated solely in the hands of the United States, but distributed across a network of emerging economic powers. For ordinary citizens, these developments may seem abstract, but the effects are real. Changes in trade patterns, currency settlements, and financial systems impact commodity prices, energy costs, and investment flows worldwide. The stability and strength of local economies increasingly depend on how well nations navigate a world where reliance on the US dollar is no longer guaranteed. In essence, the global financial landscape is undergoing a transformation. Russia's systematic de-dollarization, combined with China's strategic diversification and promotion of alternative currencies, represents a long-term effort to build resilience against external pressures. It challenges decades of dollar hegemony and sets the stage for a new era in which financial independence and sovereignty are prioritized alongside traditional measures of power. The unfolding reality is a testament to the strategic foresight of these nations. By quietly reshaping their economic policies and trade agreements, they are laying the groundwork for a world where financial influence is no longer concentrated in a single currency or controlled by a single nation. The implications for the US, its allies, and the global economy are profound, signaling the beginning of a fundamental shift in global power structures. As we reach the final part of this series, it becomes evident that the shifts initiated by Russia and China are not temporary reactions. They are deliberate, long-term strategies aimed at reshaping global financial and geopolitical landscapes. The era of uncontested US dollar dominance, which has shaped global trade, finance, and geopolitics for decades, is now being actively challenged. What we are witnessing is the creation of a multipolar world, where economic influence and financial power are distributed among several key players, rather than concentrated solely in Washington. The strategic objectives of Russia and China are deeply intertwined. Russia, facing years of sanctions and geopolitical isolation, understands that dependence on the US dollar exposes it to external pressures that can destabilize its economy. By reducing dollar transactions, accumulating gold reserves, and conducting trade in local or alternative currencies, Russia is fortifying its financial sovereignty. Simultaneously, China is ensuring that it remains insulated from dollar volatility while expanding the international presence of the yuan. Through initiatives like the digital yuan, regional trade agreements, and strategic diversification of import sources, China is building a resilient trade ecosystem that can operate independently of U.S.-dominated financial structures. These moves are not merely economic, they are profoundly geopolitical. Dollar dominance has historically provided the U.S. with enormous leverage, the ability to impose sanctions, control global liquidity, and influence international economic policies. By reducing dependence on the dollar, Russia and China are effectively diluting this leverage. Countries that once relied on U.S. financial systems for stability are now exploring alternative networks. This includes regional payment systems, bilateral agreements in non-dollar currencies, and independent financial institutions capable of bypassing traditional channels like SWIFT. The consequences for global markets are already visible. Commodities, particularly energy and agricultural products, are seeing shifts in pricing and trade patterns. Nations are negotiating settlements in rubles, yuan, euros, and other regional currencies. Over time, as these practices become more widespread, the dollar's role as the default medium of exchange may weaken, resulting in more fragmented and diverse financial ecosystems. This could introduce volatility in traditionally stable markets, but it also encourages countries to develop resilient economic policies less vulnerable to external shocks. For the United States, this represents a serious challenge. Economic policy and trade decisions that once relied on the implicit strength of the dollar must now adapt to a world where global partners have alternatives. The political implications are equally significant. The U.S.'s ability to exert influence through financial sanctions may gradually diminish, necessitating new strategies for maintaining global power and diplomatic leverage. Policymakers will need to balance domestic interests with the realities of a shifting international order where financial power is no longer centralized. Moreover, the social and domestic impact cannot be ignored. U.S. farmers, corporations, and industries heavily integrated into international trade may face reduced demand and increased competition as global partners diversify away from dollar-based transactions. While this does not imply an immediate collapse, it signals the need for strategic adaptation to maintain competitiveness and sustain economic growth in a rapidly evolving global environment. Beyond immediate economic concerns, there is a larger philosophical and strategic lesson. Financial independence and sovereignty are now critical elements of national power. The world is observing that countries capable of creating resilient trade networks, reducing dependency on a single currency, and maintaining diversified reserves are better positioned to withstand geopolitical pressures. Russia and China are demonstrating that economic strategy is inseparable from national security. An integrated approach where currency, trade, energy, and diplomacy reinforce each other. As global observers, it is crucial to understand that these shifts are likely to accelerate. New alliances, regional financial systems, and non-dollar trade agreements are emerging faster than many analysts anticipated. Countries in Asia, Africa, Latin America, and even Europe are taking note, evaluating their positions within a changing economic hierarchy. Those who can adapt and integrate into these emerging frameworks will likely thrive, while those who remain reliant solely on dollar-based systems may face increasing vulnerability. In conclusion, the events unfolding today are not isolated incidents. They are part of a broader restructuring of global power. The combined actions of Russia and China reveal a coordinated strategic effort to diminish dollar dominance, protect economic sovereignty, and create a multipolar financial world. For the United States and its allies, this presents a wake-up call. Global economic influence is shifting, and reliance on traditional structures will no longer guarantee dominance. The story of dollar decline, trade realignment, and financial independence is still being written, but one thing is clear. The world is entering a new era. An era where economic resilience, strategic foresight, and diversification are paramount. An era where the global balance of power may no longer hinge solely on one currency, one nation, or one geopolitical order. For those watching closely, understanding these dynamics today is essential for navigating the challenges and opportunities of tomorrow. Stay informed, analyze critically, and consider the far-reaching implications of every financial and geopolitical decision. The rise of alternative currencies, regional trade agreements, and independent financial systems is not a distant possibility. It is the reality being shaped right now, and it will define the future of global power for decades to come.